But straight to the news just coming in. Days after the government complained about a liquidity squeeze, the Reserve Bank has now released data of credit growth across banks and NBFCs, claiming that credit growth in the economy is healthy. Let me read the statement out from the Reserve Bank spokesperson. It says, and I quote, "The credit growth to the real economy has shown healthy growth this year, especially in the last few months. The adjusted non-food bank credit, which gives the flow of financial resources from scheduled commercial banks to the commercial sector, has touched almost 16% during the fortnight ended October 26, 2018, and sustained healthy growth at 15.6% during the fortnight ended November 9th, 2018. The year-on-year growth rate of loans and advances by NBFCs clocked 17.9% for the quarter ended June 2018 and 20.1% for the quarter ended September 2018, signifying steady growth rate in the overall flow of credit." So this is the Reserve Bank basically coming out and saying that where is the liquidity squeeze, giving data to show why it believes that the credit flow has been healthy, whether it is to commercial banks or to the NBFC sector. And the Reserve Bank clearly setting the context for why it believes that no further measures to address liquidity are perhaps required. This is what the statement seems to suggest. But it was a very different conversation that I had with the Economic Affairs Secretary, Subhash Chandra Garg, just over this weekend, where, and I quote the Secretary, he categorically stated that adequate measures have not been taken to address liquidity and that the liquidity constraints are now starting to impact consumption growth. The government wants more to be done as far as liquidity is concerned. Some measures have been taken, but the government clearly wants more for this issue to be adequately resolved. But the Reserve Bank, through this statement, seems to suggest it doesn't believe that there is a problem as far as liquidity in the system is concerned, whether that be sectoral or it be systemic liquidity. In fact, let's go across now to R.K. Bakshi, former ED of Bank of Baroda, and Anant Narayanan, professor at SPJN, joining us. Gentlemen, appreciate you joining us here, and also former Deputy Governor of the RBI, H.R. Khan. Anant, let me start by asking you, because this clearly seems to suggest that the battle for liquidity rages on. Over the weekend, in my conversation with the Economic Affairs Secretary, the Finance Ministry's view was very clear that adequate measures have not been taken to address liquidity, be it systemic or sectoral, and more needs to be done. What do you make of the Reserve Bank statement where it's basically saying that it doesn't believe that liquidity is an issue at all?
Well, Shireen, I think you hit the nail on the head. Clearly, the issues remain outstanding. And by the way, it's not just about liquidity and credit growth. It's also linked to the other two issues which were discussed in the 19th November board meeting, i.e. relaxation of strictures on the PCA banks, as well as around restructuring of loans to the MSME sector, all of which are linked to liquidity. All it tells us is that the battle lines and the differences between the RBI and the government endure even today. Nobody seems to have arrived at a compromise as yet, and therefore watch the space. But by the way, the statistics which the RBI has released is obviously right. Money is available in the banking system if it is required. Banks are sitting on excess government securities. They can convert them into cash and lend them where required. I think the problem really is certain names are probably finding it difficult to find liquidity. It's not really a systemic issue. It's probably an idiosyncratic issue. And I guess that's the point that RBI is making. And in that, you can't dispute the numbers given by the RBI.
Yes, Anant, I just want to, for the benefit of our viewers as well as for you, I've reached out to North Block, to the Finance Ministry, for their comment on what they make of the Reserve Bank of India's statement. And the Economic Affairs Secretary has just told me, and I'm quoting again, we should watch for the disaggregated numbers for the month of September and October. So in response to the Reserve Bank of India's statement, the response from the Economic Affairs Secretary to me is that we should watch for the disaggregated numbers for the month of September and October. Anant.
Again, fair points. September is when we saw the IL&FS issues flare up. And obviously in October, there was a crunch and the number of CPs probably did not get rolled over. So that was a fair point. But overall, bank credit has been going up. It's close to 15% and above 15% at this point in time. Nobody really expects a liquidity crunch to hit the system as a whole between now and March, even though there are large redemptions coming through. And the point remains, I think there is no real liquidity shortage for the banking system as such. There are a couple of issues really. One is, as I mentioned, idiosyncratic. Certain names might find it difficult to raise money. And the second part is there is still a capital shortage in the system. Banks still require capital to be able to increase their risk appetite. So it's a question of risk appetite rather than liquidity, which I think is a binding constraint right now.
Okay, Mr. Bakshi, let me get your comments in on what you make of this, because as I pointed out, it seems fairly clear that the issue of liquidity continues to have differing points of view between the government as well as the Reserve Bank of India. Now, the RBI, in its statement released just a few moments ago, says growth in NBFC advances signifies steady growth rate in the overall flow of credit. Credit growth to the real economy has shown healthy growth this year, especially in the last few months. And they go on to give the numbers for why they believe that's the case. But that is clearly not the opinion of the government. The government unequal vocally, and as I pointed out, we have it on record, the Economic Affairs Secretary saying that liquidity is a constraint. It is now starting to impact consumption. It's impacting sectors like real estate. It could then start to impact steel, cement, durables, etc. What do you make of this, Mr. Bakshi, and what does this now indicate in terms of the road ahead? Because liquidity is going to be an issue.
See, the figures given by RBI are not correct, but apparently they are a little dated. The NBFC sector, which was become a major lender to certain sectors, particularly real estate and certain other consumption-related sectors, would have definitely their credit growth would have slowed down after September, if not exactly gone into negative. They have. It's a common knowledge that they have sold portfolios to banks and they have agreed not to lend even a single rupee additional because they have to watch their own balance sheet and they have to see that they don't default on their CPs or other liabilities which are coming up for redemption. So September data, maybe NBFCs would have done up to that time the going was good. But beyond that, October and November and the months ahead, NBFC lending capacity, I think it's severely jeopardized. They have sold portfolios, so there would be negative growth. And builders and others, which were majorly depending on the NBFCs, a lot of banks in the last 1 year or more than that have not been really lending to builders and real estate sector because of apparent concerns. There are some where there might have been a default and therefore lending to them becomes a problem for the bank or delayed payment.
So, Mr. Bakshi, you're saying you don't believe that the RBI's data is accurate?
Data is accurate. Only thing is a little dated vis-a-vis NBFC's figures are concerned. That is up to September.
Dated.
After September, what is the issue?
Right.
After September, they would have gone into negative territory, and the builders, to whom we, in general, today also I was discussing with somebody, the builders say that if this doesn't improve, maybe they will have tremendous NPS up to March. Maybe more in NBFC.
Anant, sure. Anant, getting back to you, what does this then tell you about the road ahead? As I pointed out, this is a matter that's going to be taken up by the RBI board on the 14th of this month. The Economic Affairs Secretary clearly saying that, look, this data that the Reserve Bank has put forward does not give you the accurate picture. This is dated information and we should watch out for the disaggregated numbers for the month of September and October. Though the RBI is saying that the NBFC data that it's shared with us is for the quarter ended September 2018. So, Anant, where do we head from here?
So first thing, Shireen, the first thing this tells me is that we are still fighting a public battle between the government and the RBI, who are doing this not behind closed doors, but through press releases and by chatting through people like yourself. Not a good sign for the road ahead. It just tells us that we only postponed the differences. We've not really resolved them as yet. The second part, I think both parties have a point of view, which is correct. There has been a slowdown, as Mr. Bakshi was mentioning, in September and October and in the NBFC lending. And RBI is also right in saying they're providing as much liquidity as is required. They've just announced a series of OMOs. They've announced one for December as well. They've given relief on the LCR and SLR reserves as well. So I think the crux really is money is available for those who want money. The question is, when it comes to real estate, when it comes to the trust deficit around actual asset quality on NBFC books, there is a question mark. And that's not something which can be resolved by making liquidity available. It's by making sure that people understand the risk involved and have the risk appetite to lend to those sectors. That is a different solution altogether, not really liquidity.
So does this very clearly... Yeah, Anand, but does this very clearly tell you that sectoral liquidity is not something that the RBI is willing to yield on?
Absolutely, and I think that's the right stance. There is a moral hazard if RBI starts to say, please lend to this sector or that sector. That doesn't really make sense. And RBI is not equipped to actually take credit calls. It can provide liquidity, it can lubricate the system, but eventually sending that liquidity to a particular sector or a particular NBFI is a credit call which banks, commercial banks have to take. Now, if they're hampered by A, a trust deficit, and B, by shortage of capital, those require different solutions, not really flooding the system with liquidity.
Okay. So, Mr. Bakshi, in specifics now, one of the issues that is likely to be taken up on the 14th, of course, is to deal with liquidity. The other issue that was pending from the last board meeting was the issue of PCA banks. Now, the government's view is that at least 3 or 4 of those banks under the PCA framework have started to indicate a turnaround, and perhaps some relaxation is warranted there. The BFS, that's the Financial Services Committee of the RBI, is looking at that matter. But given what we are seeing now in this statement, what is your sense about the position the RBI may take on that front, sir?
We shouldn't second guess the position RBI will take, because RBI apparently will depend upon the views of the committee set up under the BFS. We shouldn't second guess it at that time. This statement is perhaps, and I fully agree with Anand Narayan when he says that we would have been in a much better position if these things were being discussed between the stakeholders, that is the government and the RBI, behind closed doors rather through these open listing. Ultimately, these are sensitive matters, and both, I honestly believe both government and RBI their interests are not disaligned. They are aligned in the sense that they want the country to grow, credit to grow, the financial stability to remain, and I think the outcomes are not debated. The path to that is which is getting debated.
Yes.
So what BFS will decide, I don't want to second guess that. Whether the same banks, the banks under PCA are enabled to lend, or it is the other banks which are not in PCA, they lend sufficient liquidity. And as another man said, RBI can provide systemic liquidity. Perhaps a method can be found where a refinancing window for banks against particular class of loans can be done, like NHB has asked RBI to increase their refinancing limit from 300 billion to 500 billion for HFCs. Perhaps that can improve some sectoral flows. But beyond that, we agree, RBI cannot take credit risk on their books, nor can they they can incentivize, like in some days back, they permitted NBFC credit enhancement by banks or NBFC lending to be taken for liquidity ratios and things like that. So that is what they can provide indirect incentives. But perhaps they cannot take credit risk on their books, nor can they directly, I don't think NBFC sector, they can set up, out of priority sector, it will become part of priority sector, or you have to lend minimum 10%. That will be a bit difficult. But perhaps a window can be created where loans to NBFCs by the banks can get some refinance, which may make it more attractive for them to do it. But NHB is there to do that, so I am not sure whether that is required.
Sure. And that intervention on the part of the NHB has already been exercised to some extent. But it's very, very clear there is no meeting of minds on the liquidity issue. This latest statement from the Reserve Bank of India seems to suggest that all is well on the liquidity front, but that is totally not the view of the Finance Ministry. In fact, let's just listen into the Economic Affairs Secretary Subhash Chandra Garg speaking about the fact that he believes that there is a liquidity squeeze in the economy and the government is fearful that is going to now start to impact consumption growth.
My sense is that the systemic liquidity issue also has been managed by OMOs and otherwise, and now we have some flows from foreign side coming also, which will also help in liquidity. But we need to be continuously on watch. Liquidity liquidity situation which got created, that could have had several kind of impacts. One, it could have been fatal for some firms, which relates to solvency aspect of it. Second, it affects the consumption, because most of these entities were financing consumption of consumer goods, durables, vehicles, also some infrastructure and other things. And they were actually taking a big amount of slack in this space, and their rates of growth was very high, 30-40%, yes, which held up the consumption story of the economy completely.
Well, that's the Economic Affairs Secretary unequivocally saying that liquidity is a problem. The Reserve Bank saying, no, it isn't. Well, Anant Narayanan and Mr. Bakshi, appreciate you joining us here. I would imagine that this is going to be a conversation we will continue to have over the next few days. But for this evening, appreciate you joining us here. Bank Rana and Madhu Kapoor have drawn up a draft proposal for mutual reconciliation. CNBC TV 18 learns the proposals include Rana Kapoor dropping his appeal against the Bombay High Court order, which granted Madhu Kapoor the right to nominate directors on the board, with certain conditions were met. Ritu Singh joins us now with more details. Ritu, take us through the details of this 9-point draft proposal that's been drawn up between the Kapoors.
Well, firstly, this comes as a big breakthrough in the efforts to mutually reconcile the two warring promoters. So now we understand from sources that a draft proposal has been drawn out for Madhu Kapoor and Rana Kapoor to consider settlement talks. And if all of the items, are listed down by both the promoters are agreed upon between the two of them, Rana Kapoor has offered to withdraw, his case challenging the Bombay High Court order that had granted Madhu Kapoor and her family the right to nominate directors on the board of Yes Bank, and has been a bone of contention between the two promoters. So what are these draft norms really? The first one stipulates that both of the Indian partners, that is Madhu Kapoor as well as Rana Kapoor, they will have the right to nominate 3 directors on the board of Yes Bank, one each by both Madhu Kapoor and Rana Kapoor, and the third director, we understand, will be jointly nominated by both of the Indian partners. Of course, the partner director that will be nominated thus will not be liable for rotation. Further, it has been agreed in the draft proposal at least, that the director appointed by both of these parties will be non-independent and non-executive in nature, except in the case of Rana Kapoor, where he has made it very clear that in the case of Rana Kapoor's own appointment, either as MD and CEO or non-executive chairman, or as a director on the board of the bank is approved by RBI and the shareholders, that will supersede whatever else is in the clause, and it will be a given that Madhu Kapoor and her family at all times will consent to her, to Rana Kapoor staying on the board in that capacity. So these are largely the conditions that have been laid down, besides which, it's also been said that the chairman and managing director can be jointly nominated, as well as whole-time directors to the board of the bank can be considered by both of the parties. But as I said, this is a draft proposal. The final terms will have to be agreed upon by both the sides, and the talks have only just begun.
All right, appreciate you joining us with that, Ritu. To Piramal Enterprises, the stock was down nearly 6% today after fears over the company. The stock ended the day lower, and what tripped it? It has an exposure to Lodha developers. The yields on Lodha's bond that mature in 2020 has risen from 12% to over 23% in about a month's time. This, we understand, may have spooked investors. Sonal joins us now with more details. Sonal, what's exactly going on here?
The stock of Piramal Enterprises took a knock of about 6% today on fears that over its exposure to Lodha developers. Lodha developers bond maturing 2020 saw its yields go up significantly to about 23% from just about 12% a month ago. Remember, Lodha's developers bonds are rated F by Fitch, which is not a very high sort of rating, and the fears sort of caught up with the market. Dealers said that whenever you have a sharp sort of jump in yields like this, there could be something amiss, some financial stress. But do remember that Piramal Enterprises had told us last month, had issued a statement saying that its exposures to developers, including Lodha, were completely sort of secure. We also understand from sources close to Lodha that there has been no default by the company.
Sonal, appreciate you joining us. Meanwhile, Lodha has issued a statement. It says, and I quote, bonds by emerging market issuers, including various Indian corporates, have fallen in the price over the last 3 months on account of global macro factors like oil prices. Our bond is held to maturity by most investors and hence thinly traded. In fact, reported trading volume in the last 3 months is less than $3 million, and hence any small move can move the price significantly. The statement further says, and I quote again, we raised $125 million at a premium price last December, and we expect our bond price to revert to similar premiums as emerging market debt strengthens in response to oil price moderation. That's the statement coming in from Lodha. Ramesh Swaminathan, the Chief Financial Officer of Lupin, will step down from his position in December. The company in a statement said that Swaminathan has decided to pursue other responsibilities outside the pharma industry. One of the highest paid CFOs in India, Swaminathan has been with Lupin for 12 years and has been a witness to the boom in the generics industry. The company is yet to announce a replacement for him.